Hello everyone, my name is Anita Harriet, President of Pall Mall Art Advisors. Today we're going to be looking at art as a liquidity strategy. And as you probably all know, during the COVID era, we are dealing with the issues of liquidity. We've seen stocks decline, commercial real estate is stagnated, so it's time to start looking at these other assets, the assets of the portfolio that are typically ignored. Now, in order to examine these liquidity strategies, we need to understand a couple of things. One, we have to understand valuation. Valuation is the foundation of all decisions. And today we'll be listening to Kate Mullitz, Director of Appraisals, who will guide us through some of the important nuances of valuation. When we begin to examine our strategies, one of the most important strategies which has developed over the last 10 years is using art as collateral and other collectables. Colleen Boyle, Senior Vice President and National Sales Director, will be taking us through some of the opportunities in terms of collateralization and also creating some clarity around it. Lastly, but certainly not in any negative fashion, we'll be listening to Jonathan Gibbs. Jonathan Gibbs comes to us from TrustPoint, and he's going to be talking about a new opportunity for liquidity, which is the art bond. And lastly, I'll take us through a little window into what's happening in the market today and opportunities potentially for liquidity in the traditional auction and private sales market. So without further ado, let's begin with Kate Mullitz, who will take us through some of the important nuances of appraisals.
Thank you so much, Anita. Good morning, everyone. I just wanted to go through a little bit of what Anita has already touched on, which is looking at some of the distinctions between what makes something a good asset for liquidity and something that you can potentially monetize, or if you're looking at donating, what are the elements that we're really looking at? And so to start is really understanding value. And a lot of the time when we talk to our clients and their advisors about value, there's a very distinct difference between what we mean by value and what they mean by value. And so I'm going to get a little bit more into the types of values, of which there are three main values that we focus on. But when we're determining a value, we really want to look at the object and the specific elements of each object. And on the slide that you're looking at now is really taking all of those things into consideration. And so when we're looking at a piece that is something that you would like to potentially monetize or donate, we're looking to see how many of these boxes are really checked for a particular piece. And the example that I have shown here would be a Wyeth. And so being a company that's based near the Brandywine, we certainly see quite a bit of Wyeth material. And it's not enough for a client to say to an institution or to even an auction house that I have a Wyeth that I want to sell. It's really looking at, well, that's a wonderful thing. We really want to focus on all of these other elements. Is it an original? Or is it a print? And if it is an original, is it an oil, which is what's the most desired? Or is it a watercolor, which can be a lower tier medium for the artist? Most importantly, what is the subject matter? For example, like the one on the screen, are we looking at something fairly basic, like rocks and water, or are we looking at something that's really has a narrative around it, and something that's an illustrative art, which he was known for? Are we looking at date and something that was made, at the peak of the artist's time? Or was this something that was done very early before he was really established, or done really late after he had already set the tone for how he was creating his place within the market? Obviously, condition, we see a lot about that. And also provenance. Is it a piece that has always been in a family? Is it a piece that's come up to auction many times? For this area in parts of Pennsylvania, is it a piece that was part of an important collection or from an important person relating to Pennsylvania history? And certainly, has it ever been exhibited, which again, in this area, if you're looking at a lot of our clients who have Wyeths are going to be in the Pennsylvania area. Has it been exhibited at all the places that we want to see? You know, Brandywine aware of it? Has it been any of the larger institutions or the college institutional collections or exhibits within their libraries or their museums? And so these are all things that really relate to that as seen in that value, which is a fair market value difference of $1 million versus $52,000. And so that's where I wanted to start before I get into the types of objects. And on this next screen that's about to come up, you're going to see a little bit more about the types of values. If we can get Anita or the team to move to the next.
I have a quick question,
Yeah.
if you could answer it for me.
Of course.
So as we look at each of these categories of analysis, and that's the way I like to think of them, in the case of this Wyeth, which is the category of analysis that has had the greatest impact on value for this particular work, and the differential between the one at $1 million and the one at 52,000?
Oh, it's certainly going to be the subject matter. So for, like I said, for somebody like a Wyeth, you really want something that speaks to why the artist is, why is the artist, to be as simple as possible, why is the artist famous? Why are they collected? And looking at somebody like an NC Wyeth, we want to see something that has a narrative around it. We want to see something that's illustrative art, and that kind of touches on all of these points, and that is in oil, and that shows off kind of all of the boxes within subject matter, within size, within everything that really, once you determine what the best is, which is looking at in terms of subject matter, does it then tick all those other boxes, which this particular piece does.
So that's the most important thing I want people to understand, is that with all of these categories of analysis, it seems that if one of the categories is off, it can have a devastating impact on value, correct?
Absolutely. As for example would be, this is why we're using this example, which is pieces that are very similar in size. They're both oils. They're both done around the same time. And they're both well executed, but the one that sold for $1 million in terms of subject matter is light years above. So really we're looking at only one thing that's really different between these two, and that's subject matter.
Great. So thank you, Kate. So take us through these different kinds of values. I mean, I know I meet with clients all the time, and we always say, hey, what's the value of your collection? And usually it seems as though they do not understand where they're getting their own values.
Sure. So, and as I mentioned when I first started speaking, there's always a big difference when we sit down with clients and their advisors about when we say, you know, what's the value, or when we throw around words like value, it can mean something very different to everybody sitting at a table. You can have 6 people sitting at a table, and each person has a different sense of value, what it means, where it comes from. And so really there are three types of values that we really focus on in what we do. And that's retail replacement, fair market, and marketable cash. And to go through those a little bit more, retail replacement value is what is really primarily only used for insurance. So a lot of our clients will, if they purchase at a gallery, whatever they paid for it plus all of those fees, that would be considered the insurance value. Anything that's on their schedule, insurance value. This is where we see a lot of clients get confused, say when they have a parent pass away and they say, it's okay, we know the value, we have their insurance schedule we can use. And that's an inaccurate value to use for an estate, or for looking at family division, or if that parent passed away and you're looking to potentially donate things under their name or the estate's name, that's an incorrect value. And so again, retail replacement value is only used for insurance. And that is to make sure that in the event of a loss, that the client can be made whole in a short period of time. As an example to that, if that piece were to fall off the wall, we want to make sure that that client can contact the gallery who represents the artist, or looking at the dealer, or any sort of a sales, looking online and being able to say, where is it selling right now that I could pay for it right now and have it delivered to me? And then that also includes tax, shipping, framing, and any other fees that might go into getting that piece completely replaced in today's current market.
Thank you. So that's insurance. So from a liquidity perspective, which value are we looking for when we're looking at liquidity?
Sure. So it depends on, for liquidity, it's typically marketable cash value. It really depends on what exactly the client is going to be using it for. So for example, marketable cash, I'm going to start with fair market value actually, because that kind of leads into marketable cash. Fair market value really applies to the majority of what a client will use, the value the client will use most often. It'll be used for estates. It'll be used for donation. It will be used for divorce, anything that's related to tax implications, distribution. That's when you're going to use the fair market value. That's what the IRS is going to require. And so at that point, we're really looking for open market records. Retail replacement is a closed market, where fair market is an open market. Typically, it means auction. It's the secondary market for a work, and with the replacement or the retail being the primary for the most part. And for fair market, we're really looking at what is that piece going to sell for at auction, and it includes the premium. So it's that premium that is paid to the auction house for the sale of the piece, as mentioned here in the example that I give, which is a 20% buyer's premium. Marketable cash is very close to fair market value. It's just less that premium, and less any of the fees associated with it. It is just strictly the hammer price of something. And where we see marketable cash value come into play most often is when we're looking at clients that are using a piece possibly as collateral for something. Sometimes we also see it in divorces, depending on the scenario, the financial scenario of the couple.
Thank you, Kate. So you've kind of articulated this very clearly when you've looked at, insurance versus marketable cash and fair market. But I know that clients get extremely confused about a differential between primary and secondary. Can you just help us and use synonyms that clients will understand?
Sure. So again, it always goes back to making sure that everybody at the table knows the language and is all on the same page about what something means. And so what we see a lot is if say, for example, a client wants to donate a Picasso print, there are probably no less than 100 examples of that piece selling on the secondary market, which would be the auction market. And for donation, because it's for tax purposes, we would be using fair market value. So it's very easy, not easy, but it is fairly easy to come up with examples of that piece selling on the market multiple times over the last 2 to 5 years. And what we run into more often with clients are, especially when it comes to something like donation, where a lot of the time pieces being donated tend to be pieces that were unique, pieces that are quite large, or were commissioned particularly. And the reason that the institution is so interested is because it's so unique. And we've come across this quite a bit with clients who have collected for a very long time and have been involved with different institutions. And so the example that I give is really looking at a piece. So for an artist that does not have a secondary market, this is an artist that is only in the primary market, which is retail, or going directly to an artist to have a piece created. And so we see this quite a bit, and really looking at what does that mean then? How do we come up with that fair market value that will satisfy the IRS? But if we were to look at a piece, say, like the piece on the screen, and say, if we're going to compare that to a similar artist at fair market, that's not the primary market for this client. It's not the most appropriate market is what we have to determine. And so the most appropriate market for this place, for a piece like this, is not auction, because it has never come up. Nothing that's like it, nothing by this artist. And so at that point, the appraiser has the opportunity to really come out on behalf of the object and say that the most appropriate market for this piece is a primary market. And therefore, instead of using a market comparable approach, we can really look at a cost approach. And so what would have been closer to $5,000 had we used a comparable that really wasn't quite that comparable at auction, around the $5,000 mark, is really something where the donation value, we can lobby for it to be at $38,500, because we're looking at what that cost approach would be to have the piece created. And so this is something that we've done fairly regularly, but it's understanding that difference between the primary market of the retail or directly from the artist and the secondary market, which is auction, and then being able to determine what is the most appropriate marketplace.
Yeah, so Kate, but if we're discussing liquidity, please let's be clear. That means that if a piece does not have a secondary market, it would be very inappropriate for liquidity, correct?
Correct. It can be very difficult. We've seen some clients who are able to, or depending on the piece, again, if it's a unique piece, say like the piece here, we have seen opportunities for private sales, but certainly for liquidity, you really want to be focusing on those objects that have a secondary market, because that's where any buyers are potentially looking for there to be room for investment, and pieces that have the value of a proven value over a period of time, and then looking toward the future.
Thank you so much, Kate. So the baseline of all decisions about liquidity are related to the actual value of the item. So let's take a look at one of the important strategies, certainly one of the areas where we see the greatest growth, and certainly with the economy today, I know that there are a lot of clients that are looking to collateralize their collections. So Colleen, can you please take us through some of the basics of collateralization?
Sure, Anita, thank you. So why would somebody want to consider collateralizing a collection? Well, amidst the health epidemic and the constant fluctuation of the financial markets, a collection can be a source of strategic capital. Collections can be used as collateral to gain liquidity for all different types of financial opportunities. An individual may want to expand their business, or they may want to invest in a new business. In today's economy, they might need to refinance some debt, and they could actually gain that liquidity from a collection to do that. They might be interested in acquiring additional assets to diversify an investment portfolio. Now might be an opportunity to borrow against an art collection to acquire more art. It might also provide the opportunity to manage short-term cash needs, such as life events. Clients might need liquidity for medical costs. They might have tax payments, or it might be used for a divorce settlement. And lastly, we see clients leveraging their collections to achieve estate planning goals. Those are the primary reasons that we're seeing that an individual might want to consider collateralizing their collection, Anita.
Got it. Now, we've just heard from Kate. We looked at the differential between secondary and primary markets around artwork and other collectibles. Take us through the kinds of pieces you typically see are collateralized.
Sure. So there's many different types of assets that can be used for collateralization. The issue is, as Kate mentioned, they do need to have a secondary market. There needs to be an auction history for that particular asset in order to use it as a collateralized opportunity. For example, if we look at art collections, they're a fabulous source of collateral as long as the artist has an auction sales history. If a collector has predominantly emerging artists in the collection who only sell via the dealer retail market, this would not be a preferred asset for collateral, but this type of asset could be recommended for a donation strategy. So the most important factor in choosing what type of asset would be most suitable for collateral is to be sure that that particular asset does have a secondary market or auction history for data points. And the types of objects that we tend to see for collateralization include fine art, jewelry, collector cars, coins, and other valuable types of assets could be well suited for collateral.
So I know
I'd like
that, yeah, I'm sorry. I was hoping that
Yep,
you
go
could
ahead.
talk a little bit now about the difference between recourse and non-recourse loans. Certainly many of our clients are banking clients, and I imagine banks can help them, but that can be a tricky business. So can you give us some context and when you decide whether to go recourse or not?
Yes, so there are two different types of loans. when an individual is considering collateralization, recourse versus non-recourse. So a non-recourse loan is one in which the object is the sole collateral. So the underwriter is looking solely at the collateral and underwriting the integrity and the value of the collateral. If the borrower is unable to make payment on the loan, then the lender can take possession of that object, but they cannot pursue the borrower for any other additional assets. For the recourse loan, the object again serves as collateral for the loan, but the borrower must also give a personal guarantee of repayment. So what does that mean? That means if the borrower defaults on the loan and the object pledged as the collateral is not of sufficient value for the bank to recover the full amount of its loan, then the bank or financial institution can make a claim on the borrower's other assets. So an institution is using the object as collateral, but they're also underwriting the creditworthiness of the client, not just that of the asset. Oftentimes we find a difference between a non-recourse versus a recourse loan. Often with the recourse loans, it's a UCC filing that's applied to the object. The individual is able to keep, for example, an art collection hanging on the walls in their residency. If it's a non-recourse loan situation, usually there needs to be a third-party location during the course of the loan. If an object is on loan at an institution, for example, if art is actually on loan at a museum, it can stay at that museum with either a non-recourse or a recourse loan during the life of the loan. If a client's looking to collateralize their jewelry collection, the jewelry would need to be put into a third party, usually safety deposit box, during the term of the loan for safekeeping for a non-recourse loan, since that is the sole collateral for repayment.
Thanks, Colleen. And that really ties in very nicely with Kate's discussion of the kind of values we use. So can you please correlate the kind of value you use for a non-recourse loan and the kind of definitions that Kate provided?
Sure. So it really depends on the credit underwriting and the requirements of the financial institution who are underwriting the loans, these types of collateralized loans. Most of the institutions are going to require a fair market value to determine what the liquidity opportunity is for that particular asset. As Kate mentioned, a lot of clients do insure these objects and they have an understanding of what the retail replacement value would be for these objects. That is a different value. The fair market value, again, equates to what this object could potentially be sold for at auction and what is the secondary market history, what are the data points at auction for these objects. And that would be the value that would be utilized to determine the amount of liquidity that could be borrowed and utilized against this type of asset.
Okay, so say I do have a painting or a piece of jewelry, and you know what? I think the time is now. I need the money. I'd like to collateralize the object. Tell me, is it a very difficult process or is it a straightforward process? Tell us a little bit about the process.
Yeah, the process is actually very, very straightforward. So the first thing a client would need to determine is the value of the collateral. As Kate mentioned, understanding what is the fair market value of that particular object or collection of objects. Once the client has an understanding of the value, then they have an understanding of how much can be borrowed, and they'll apply for the loan. The underwriter will then review either the object itself or they'll underwrite the object and the client, depending on what type of institution is chosen for the loan process. And the terms are agreed upon, the loan is approved, at which point a UCC is filed on the object or the object is delivered to a secure location during the term of the loan, and then the funds are wired. So the process itself is very straightforward, but it does all start with the valuation and understanding the value of that object to determine the liquidity opportunities.
And how long are these loans typically for? 12 months, 2 years?
Yeah, so the terms of the loans as well as the cost of the loan is going to vary. So we have seen loans structured for a 12-month period with the option to renew. We have seen loans structured for a longer time period. We've seen lines of credit. We've seen term loans. It just depends on the financial institution, the object, the creditworthiness of the client. That will all vary. Usually rate is tied to LIBOR. Again, if the loan is really based on the asset only, the rate will tend to be higher than underwriting both the object and the creditworthiness of the client. But again, those rates will vary. It's really dependent on each financial institution.
And Colleen, can we suppose you have an object, you've gotten a loan on it, can you sell it while it is currently under loan?
Absolutely. So if a client obtains a loan on the object and then they decide to sell the object, they're able to do that, obviously, as long as they recoup the amount of money to pay off the loan. If they don't recoup the amount of money to pay off the loan, then there would be obviously an issue depending on how the loan was structured. But as long as there is enough there are enough proceeds to pay off the actual loan amount, it is absolutely fine to sell the object during the term of the loan.
Perfect. All right, well, thank you so much. Can you talk us quickly, if you're looking at that first step, which is valuation, sometimes does it make sense to get a full valuation if you can't even, in fact, get the loan on it? What is a pre-loan evaluation?
Yeah, so basically a pre-loan evaluation, Anita, is, again, taking a look at the collateral and having a general idea of what the fair market value would be. But it's more than that, too. It's really understanding the integrity of the object. Are there any provenance issues? Are there any potential title issues related to that particular object that would prohibit the object from being collateralized? Oftentimes with a pre-loan evaluation, it's an opportunity to determine which objects would be best suited for collateralization. Maybe a client doesn't need to collateralize their whole entire collection, but maybe just a portion of that collection. So those discussion points are really, really important prior to going through the actual loan process. And there's several different advantages on why a client might consider a loan or collateralization versus selling. And primarily, it's really it's a quick access to cash. A client might have the intention to sell at some point in time, but maybe the auction is 6 or 7 months away and they need the liquidity today. So by leveraging these assets, by collateralizing these assets, it gives a client quick access to cash. It might be too that maybe the client has committed to lending an object such as art to an art institution, and maybe it's on loan for a year or two, and they're not able to monetize the object, but they still can use that object as collateral. They still can utilize the art piece while it's on exhibit as a means of liquidity through a collateralized loan. There also might be an emotional attachment to the object. Clients really enjoy these objects, whether it's jewelry or collector cars or fine art, and they might not be ready to part with that object, but they can still utilize that object as a financial tool and as a collateralization opportunity. In addition, if the object has appreciated in value, there could be potential capital gain tax issues if a client were to sell during lifetime. So another reason to consider a collateralized loan is to avoid paying any type of a capital gain tax. And then lastly, the factor to consider is the marketable a favorite time to sell? Maybe the market has softened for that particular object, and maybe it makes more sense for the client to hold on to that object a little bit longer, but they could still utilize that object as a financial tool and as a liquidity opportunity. So these are the primary reasons that we see that a client would consider collateralizing an object versus selling an object.
Perfect. Thank you so much. And is there anything else you want to add about collateralization that I haven't asked you that we should keep in mind?
No, I think that pretty much sums up the process, as well as the types of objects and why somebody would consider collateralizing a collection. I would just like to reemphasize just this idea of really understanding the value of the object and truly the fair market value of that object, so that they have a good understanding of what the potential opportunity is for collateralization.
Perfect. Thank you so much, Colleen. Now, what we're going to do is we're going to hear from an area of liquidity that most of us are not familiar with. So, Jonathan, I need you to be patient with us and provide this in a way to pretend we're all dummies. We need this in the clearest way possible, because for most of us, the concept of an art bond is very, very new. While many of us are quite familiar with a financial bond, we're not clear on what an art bond is. So I guess the first thing I would ask you to do is introduce yourself, tell us a little bit about your firm, and then please, in your most basic way, describe what is an art bond.
Sure. Thanks, Anita. My name is Jonathan Gibbs. I'm the CEO of TrustPoint Partners. And TrustPoint Partners is really the marketing arm of our bond company, which is Angelus Group Holdings. To give you a little bit of an idea of what the bond technically is it's a boutique securitized and rated financial instrument that takes the form of a bond, and it's designed to provide asset owners a steady income stream against their illiquid assets. And by illiquid assets, I mean specifically fine art and sculptures circa 1850 to present. In our structure, asset owners become limited partners in our company. They're provided complete transparency to all of our processes and guided by the financial experts within our company in the space that really invest in the strategies that we've brought into play. They're provided monthly payments, which is also very important, throughout the course of the program, with the potential for a significant balloon payment at the maturity of the bond. That should give you at least an overview of what the strategy is here.
Sure. And then are you regulated the same way that the bonds that we would, the other kinds of bonds that we would have in our portfolio are rated? Like, how does that work?
Absolutely. We're regulated in this particular instance by the SEC. We're rated by a top-tier recognized player in the rating industry. In addition, there's also a proprietary insurance piece added within the bond to the assets that provides additional regulations.
Got it. And in terms of the term of the art bond, is it, how long is it for? And can you describe that to us?
Sure. Very, very easy. The term of the bond will be 5 years.
And what kind of revenue can you expect from it? How is it determined what your monthly payments would be? Is it, how is that value determined?
Well, the value will be determined initially by the valuation provided to the asset. That will make up a percentage of the company. And within that, your percentage of the business, you can expect a monthly payment within that range of your ownership in the company. And again, you'll receive at the end of the term, once the bond is paid back, there'll be a balloon payment of which you'll receive a significant amount of money.
And what's the value of a piece that we would put in a bond? What's your threshold?
So the typical assets will be in the anywhere. Again, I want to emphasize first that you need. It'll be a circa 1850 and newer painting and or sculpture from well-regarded artists. So Pall Mall will play a significant role as advisors in helping to select and analyze and recommend the appropriate pieces. As it pertains to the valuation, the typical assets will be provided somewhere in the approximate 50% valuation, again, as confirmed by the experts at Pall Mall, and placed in the bond. We will analyze any pieces in excess of $1 million and up, and certainly collectors with numerous works will also be accepted. So if they're smaller pieces, but they make up a larger swath or dollar volume, they would certainly be accepted in the program.
Got it. So you're saying that, for instance, a gallery might be able to take works that they're not currently buying and selling and place them in the bond. Is that correct?
Yes, absolutely.
Got it. What if you have it in the bond and you actually want to liquidate it? Are you allowed to liquidate it while it's still housed in the bond?
That's a great question, Anita. In the event that someone is offered a certain sum that is just too good to be true, all they would need to do is certainly provide whatever the asset value was that was utilized in the bond itself. They would, upon sale of their asset, they would replace their asset with that amount of money, that dollar value, into the bond, and anything above and beyond is their money.
Got it. And what about all the costs associated with the bond? Does it need to go into secure storage? What about insurance? Like, who pays for those fees?
Angelus Group Holdings, really where the bond is housed, will absorb all of the expenses, and those are expenses that are figured into the company expenses.
Got it.
As it pertains to the safekeeping, safekeeping is going to be approved on a piece-by-piece basis. Most well-regarded facilities, both domestically and internationally, would be acceptable. And in some certain specific instances, asset owners might even be able to maintain their paintings in their homes hanging on their own walls. That is a possibility.
And I imagine in museums as well?
Absolutely.
And then after the 5 years, then how does that work?
So at the end of the 5 years, the bond matures. The asset is returned to the asset owner once all the payments are made, the bond payments are made, and the balloon payment will also accompany the return of that asset at that time.
I mean, to me, this is, a revolutionary concept. I know many art collectors, dealers, et cetera, are always trying to figure out a way to create recurring revenue. What made you actually come up with this idea? Did you see a gap in the marketplace, or, where did this idea come from?
Well, in our experiences with Trust Point Partners, where we provide financing against assets, we consistently saw the issue where an asset owner would take a loan, put themselves in the position where they had to make monthly payments, and realistically just didn't have the aptitude, or they just didn't understand how they were going to make that payment. They didn't think about it up front. They were able to make certain payments, but after a while it was typical that they might have been foreclosed on or lost their piece. So this puts them in a company with full transparency, puts them with a group of financial experts that will provide them guidance as far as from an investment standpoint, from the company's investment standpoint, utilizing the company's strategies, provide them a steady stream of income and a balloon payment at the end, while maintaining the security of their asset throughout the whole maturity, throughout the whole life of the bond.
And one last question. Now, do you see with COVID and the impact on the market, do you see this as kind of an even more important opportunity for clients as they're looking at their real estate and other assets?
Absolutely. Look, people will come out of this looking for security, looking for steady streams of income. Some people have taken hits in a lot of different manners. As it relates to art, and you are certainly the expert on this, art doesn't really depreciate, or at least the good, solid, fine pieces don't depreciate significantly. And so that allows someone to go out and utilize and monetize their asset, put it in a vehicle that's a safe, well-tuned vehicle that provides them a steady stream of income and the potential for a significant upside at the end of that period. So in essence, an illiquid asset that's sitting on their wall or sitting in storage now has the ability to provide significant cash flow streams to certain individuals.
Right. Well, thank you so much, Jonathan. This has been extremely enlightening, and I know our listeners will agree. If they have further questions, I imagine they would just contact you at the email we've provided.
Absolutely.
Thank you so much. I appreciate it.
Thank you, Anita.
So we've heard about collateralization. We've heard about the art bond. We all understand the values. But the question of the day is really, what is the impact of COVID on the current marketplace? What I'm getting on a daily basis, and Roxanne Cohen, our Director of Advisory, is also getting, are lots and lots of inquiries asking the following question. 1, is this a good time to sell, i.e. liquidate? 2, Is this a time to buy distressed artists? Both questions are asked to us on a continual basis. So let me address the issue of liquidity. As you probably know, most of the auctions, the major auctions, have been moved to June and July. Christie's and Sotheby's both have moved all of their major auctions to those dates. So that's very important for us to understand. And then November will continue as expected. That being said, we're still following very carefully to see whether or not these auctions will happen. But if they do, these are anticipated to be major sales. That being said, Sotheby's and Christie's already are very, very attuned to the online marketplace. And Sotheby's is having weekly auctions, jewelry auctions, and other weekly auctions. So there are going to be quite consistent auctions in the marketplace. Now, that's a way to sell, but the question we all want to know is, are we going to sell, and can we reach liquidity in a way that it is not distressed? So I thought I would give you a few examples from last week to give you some insight into the marketplace. So we saw this sale happen just a week and a half ago, and I thought I would share it with you because what's important is this is a design sale at Sotheby's. Harry Batoya was typically in a fine arts sale, was placed in a design sale with an estimate of $30,000 to $50,000. The artist has a pretty steady marketplace. We know we can value his works quite easily based on all the comparables. However, as you can probably see, this particular work sold for $300,000 on a completely online platform. Nobody in the room. That gave us a quick insight into kind of what's happening in the marketplace. And we've said this for some time, but particularly for design, functional pieces that we can use in our home and the art that we place in a design scenario. We have seen that with single owner sales. We're seeing that with design. So we do believe that there is good liquidity specifically around design currently, and online is the way to go because we're all sitting at home dying to do something. I also wanted to give you a sense of when it makes sense to sell something. Now, we have seen this list provided by Kate, and it's important you see it because many of you have wealth advisors that help you figure out what stocks. Your portfolio manager helps you pick out your stocks. You work with a real estate investor. But how do you determine the value of the work of art and whether or not you will achieve liquidity for it? I just want you to think of it in the following way, and it works for both acquisition and sale. As Kate went through each of these categories of analysis, if you're anticipating a good sale liquidity, you need to have a B plus next to each of these categories of analysis. If you have a B plus next to each of these categories of analysis, you probably have a steady asset that can sell well. I thought I would give you an example from last week. This is the Orientalist Sale. That is an April sale that happens once a year at Sotheby's. And this is an artist, a female artist. And as you know, female artists have become more and more important on the marketplace. It was estimated for 50 to 70 and sold for 795,000 pounds. So here we're seeing, again, areas of the marketplace where there's a B plus next to each of those categories of analysis. We are still seeing great interest for acquisition at auction. Now, not every object is going to go up in value, and we want you to understand that. And what is important to understand is that sometimes works of art that have depreciated in value and may have a long-term depreciation, they may not gain back the value that you put into it. That still gives you significant opportunity. We know that when a piece sells above what you've paid, there are capital gains to consider. What we understand is that there are certain pieces that, in fact, like this John Marshall Gamble, may have gone down almost $100,000. What we recommend, depending on the artist, is it may make sense to still liquidate that object in an appropriate sale and take the money in which you will not pay capital gains and have it reinvested. Have it reinvested in another artwork with it that does have long-term asset value. Have it reinvested by your portfolio manager, your wealth advisor. Have it reinvested into real estate where there's great opportunity. So just because something has gone down in value doesn't mean it's not a good opportunity for sale. So I hope that you have found this to be helpful, that we've provided you with some insight into the liquidity of the art and collectibles market. If you have any questions, please reach out to us and we'll be sure to answer any questions that you might have. Have a wonderful day and thank you for attending.